天线资本本期视频为您带来的是摩根大通在4月4日录制的关于全球外汇市场的话题，主题为全球利率、欧洲利率与特朗普关税王牌。全球经济刚刚受到了一个大冲击，最近美国宣布的关税范围和力度都超出了所有人的预期，可能会把美国的有效关税税率推高到 23% 左右。这意味着什么？有专家直接把今年的全球衰退风险概率从 40% 提高到了 60%， 这可是个大调整，特别是对欧洲来说，增长前景不妙，下行风险非常明显，这可能会迫使欧洲央行不得不降息，甚至进入宽松周期。德国债券市场已经出现了剧烈波动，收益率快速下跌，而且随着避险情绪升温，收益率曲线甚至可能趋于平缓。同时，各类利差正在扩大，这反映了市场风险偏好的下降。虽然关税对欧洲通胀的具体影响还不完全明朗，但全球需求疲软带来的增长放缓正在拉低通胀预期。这段录音会深入探讨这些关税到底是怎么冲击欧洲市场的，这里面有哪些风险，对利率甚至对你的投资策略可能意味着什么，值得你仔细听听。接下来是英文会议的全部内容，如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hi and welcome to At Any Rate, JP Morgan's global research podcast series, where we take a look at some of the drivers behind the biggest trends and themes across fixed income, currencies and commodity markets. I'm Francis Diamond, Head of European Rate Strategy at JP Morgan, and today I'm joined by my colleagues Aditya Chordia and Kikendra Gupta to discuss the European rates market reaction to the US tariff announcements this week. We're recording this podcast on the 4th of April, and our comments today are based on our published research available on JP Morgan Markets. So it's fair to say the US tariffs announced this week were larger and more broad-based than we or the market had expected, which if fully implemented will take the US's effective tariff rate to around about 23%. In terms of Europe, the 20% tariff on EU exports to the US is larger than expected, and the US has applied a baseline 10% tariff rate to UK imports. So I think at face value, in our view, these announcements have a meaningful global implications, probably will lead to a significant global demand shock. And in light of this, our global economics team have increased the probability of a global recession this year from 40% to 60%. Obviously, the policy situation is still very fluid. There's a possibility tariffs may be dialed back in the coming days, but at the same time, retaliation is also possible. So I think given that, our macro forecasts are under review just as we wait to see how the politics of this week's announcement play out. But I think we feel fairly safe to say European growth risks are tilted to the downside. So in terms of European rate markets, I think it's a similar theme in terms of yields are still tilted to the downside. We've obviously had a pretty big rally in rates over the past week, but we still don't think a recession outcome is fully priced into yields just yet. But it may take some time to see clear impacts on activity data. So Aditya, let's start with German market and how you see things in light of the market move this week. How do you think about German yields, the likelihood of an increased recession risk, and what about the German curve?
Sure, Francis. So this has been another monumental week for global rates market. I think we are getting a bit of a theme of that this year with DMEs, which were rallying aggressively this week. And the 10-year German yields now have fully reversed the German fiscal U-turn-led sell-off, which we saw in early March. Like we moved 10-year German yields from around 250 to 290, and now we are back to 250. So a bit of a round trip. We, on the duration side, we have been advocating a strategic bullish stance post the German fiscal U-turn-led sell-off in early March. And we have been targeting 10-year German yields to decline from the 290 peak reached to around 240, 250, but we were hoping to reach there in months, not in few weeks. The 240, 250 target also was under our pre-tariff baseline scenario of euro area growth improving over 2025 because of the fiscal impulse. And we are only incorporating a growth track from an equivalent tariff hikes of around 10%. So clearly what we got this week was quite extreme relative to the baseline forecast we have. And as we discussed, our econ forecasts are still under review, and it's still a bit too early to change that because there is such a fluidity in this situation, like the retaliation, negotiation and everything. But to state the obvious, we see material downside risks to the growth. And also the global impact of this abrupt change in the trade regime is likely to have significant demand dimension to it, which creates additional downside risks for euro area inflation over the medium term. So from an ECB point of view, the impact should be to have policy rates much lower than what we were incorporating before. Again, we haven't revised our ECB call yet, but I think our econs are stressing that April is a live meeting now, and most likely policy rate might have to go into easy territory. For this reason, the impact should be the bias of ECB policy rates lower, as we discussed, and also that will also give a downside bias to this 10-year German Bund forecast we had around 240, 250. The development this week have materially skewed risk to the dovish recession scenario, and therefore we continue to stress that current 10-year bond yields, even after the large rally of the past couple of weeks, is still attractive for investors with long-term trade horizons. Another interesting thing which happened is on the German curve. The German curve, especially on the 2-10 segment, the directionality of the 2-10 segment has been quite choppy recently, and it continues to screen quite steep on our long-term model versus money markets and ECB balance sheets. We have been attributing this excessive steepness to increasing term premium pricing, like roughly around 20-30 basis point, most of it which was put in the curve after the German fiscal U-turn, and it's still stuck in the current curve valuations. So from our point of view, we believe that given this term premium pricing, which is already in the curve, the 2-10 curve will struggle to steepen further in scenario of further repricing lower of ECB expectations on increasing recession risk. And on the contrary, we believe that the curve could even start flattening in a bullish way as term premium risk tends to fade on increasing growth risk, as typically you will assume that who will sell, which is a term premium concern, will be overtaken by flight to quality demand. So net, we believe the German curve, especially in the 2-10 segment, could be biased flatter from here.
Okay, thanks. So, Jigendra, if we maybe look a bit at bund spreads and swap spreads in general, I mean, 10-year bund spreads widened on the week. Does that make sense to you? How do tariffs trade fit into your swap spread framework?
Yeah, Francis, 10-year German bond futures spreads have widened around 6 basis points this week, with most of this moves coming on Friday itself as the risk of sentiment accelerated. This large weekly move sits in the top 5 one-week widening moves seen in Bundesstraße spreads over the past few years. Now, just to give a perspective, Bund spreads were mostly sleepy early in the week, as we believe that the typical widening that you expect in a rally was initially, early part of the week, was met with continued interest in narrowers, which investors continue to pile on, expecting the impact from increasing German fiscal issuance that Aditya was mentioning earlier. But spreads then jumped wider, mostly on Friday on risk of considerations. I think the overall move in spreads seem reasonable, even though it was kind of backloaded. To give a perspective, a 6 basis point of widening in bund spreads over the week has come along with an overall rally of, let's say, about 25 basis point in bund yields. That is around, give or take, 25% beta, which is roughly in line with the beta seen over the last 3 months, beta of bund spreads versus bund yields over the last 3 months. We have been highlighting that the beta of swap spreads to yield should exacerbate in a risk of rally, and the move this week kind of corroborates this. So I think spreads could continue to widen further if the risk of sentiment lingers on. You also asked about the inclusion of tariffs into our swap spread framework. Well, we do not really have a direct variable to plug in and output in the model for tariff rates on spreads, but it does get incorporated via German yields and the peripheral spread angle. Amongst other variables, we also include, as I mentioned, bond yields and 10-year weighted peripheral spreads in our long-term fair value model to capture the typical directionality of, or rather typical negative directionality of swap spreads to yields, and the flight to quality type moves captured by peripheral spreads. So the tariff comes in via these channels into my framework. And interestingly, bund spreads now appear broadly fair in these long-term value models. In fact, short spreads also appear fair on these models. I think on short term, this strong negative directionality to spreads will remain, and spreads are likely to widen if the rally continues on.
So, Aditya, coming back to you and maybe sticking with spreads as a theme, what do you think the read across is from the announcements this week for intra-EMU spreads then?
So Francis, like the interim spreads have widened sharply since the US tariff announcement on broader risk of tone in global markets, which is not surprising. Like what we had was going into this week, we were advocating a very high conviction, cautious intra-EMU stance, given the tariff risk event, which was quite high and the valuations were expensive and position was overweight. So clearly, I think the move is going in the right direction. And we have been stressing that given the heightened global uncertainty around, especially given this whole trade uncertainty, it is not the time to have overweight, like the carry exposures, as current tight valuation does not compensate for potential volatility or uncertainties. So given these developments and the increase in global recession risk, we still remain comfortable with a cautious stance at this line. So Francis, turning back to you, what do you think the tariff announcement means for the inflation and inflation markets?
Well, I guess given what's been announced, and obviously we'll just take at face value what we have, the impact of tariffs is probably more short-run dynamic for US inflation, reflecting one-off price level changes in the coming months, given the large increase in the effective tariff rate for the US. But however, for the euro area and the UK, given we don't have any details on anything retaliatory for now, the impact on inflation, I think, is less clear. I think probably the channel of weaker growth from reduced global demand will push down on inflation, but potential disruption to supply chains globally and if we see any European retaliatory measures could offset and actually result in some increased price in Europe. So for now, the rough estimate, you think probably near-term effects of the tariffs so far in HICP are pretty small, and maybe over the medium term could maybe add 1/10 or maybe 2/10 on HICP versus our current forecasts, given the global supply chain dynamics. So I think in terms of inflation markets, I mean, the themes we've been highlighting is generally this kind of theme of divergence between Europe and the US, and that's kind of continuing. So 10-year European break-evens have actually been falling over the past few weeks. That's been unwinding the large spike higher that was seen after the German fiscal shift in early March, and probably increased downside growth risk will keep pressure on break-evens to continue to fall. And if you look at real yields in the euro area, they're probably too high, and I think they can probably decline from here. In the UK, slightly different dynamics. There's some annual price resets coming up in April. We have the pass-through of the NI business tax hike. That will push service inflation likely higher over April. And probably headline inflation is expected to peak in September, somewhere above the 3% level. But I think despite this kind of slightly bumpy inflation profile, I think probably, again, it's a growth story, and the downside growth risks are the more relevant for UK break-evens. I can probably weigh on UK break-evens going forward from here. So that's it from us. Thank you for listening. Stay tuned for more updates on the fixed income space here on At Any Rates, JP Morgan's Global Research podcast series. This communication is provided for information purposes only. Please read the JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2025, JP Morgan Chase & Co., all rights reserved. This episode was recorded on the 4th of April 2025.